What is going on, guys? Nick here, back with another video. Has inflation peaked? I feel like over the past couple of weeks I've seen a lot more headlines starting to ask this question, and I just came across a blog post that basically is arguing that inflation has probably peaked, but significant risks still remain. So basically, he starts out talking about the CPI increase that we saw, where there was actually a slight decrease in year-over-year inflation, where in March we saw 8.5%, and in April we only saw 8.3%. Those are obviously still very high numbers, and then when we take a look at the core inflation, this went from 6.5% to 6.2%. His argument basically is that a year ago, we have a big increase in the price basis. This is kind of like how right as COVID hit, there was also the big semiconductor shortage that happened, and we saw a decline in the amount of new vehicles on the market, which caused an increase in the price of used vehicles. So now for inflation to continue, we're going to have to see those numbers continue to increase at the same rate. And his argument is basically that the prices are already up very high, and it's going to be much tougher for them to continue to increase at the same rate going forward. In this article, he basically calls it a base effect. So right here, April, May, and June of 2021 had the fastest pace of core CPI growth in nearly 50 years, thanks to a spectacular increase in used vehicles and other durable good prices. And that jump in prices was pushing year-on-year core inflation significantly until now. So now that those used car prices are being compared with their higher numbers of last year, we're not as likely to see the same increase. Now, the next reason is basically a tightening of the economy. So this right here is the Chicago Fed National Financial Conditions Index. It basically takes out a lot of the economic conditions going on. So basically taking a look at things like risk, leverage, and credit. So for a lot of you guys are all stock investors. I would say an equivalent to this would be compared to last year, when we saw prices up very, very high, everybody was making a ton of money in the stock market. Ask yourself, how willing do you think last year were people to take out margin accounts with very high amounts of money that, in all likelihood, they probably really couldn't pay back, and then use that to buy really highly leveraged options, whether it's very tight credit spreads? How likely were people willing to do that last year versus now? And that's kind of the idea when we look at this tightening up of the overall economy. We can see when this number is higher, that's considered a tighter economy, and when this number is lower, that's considered a much looser economy. So what we can see right now is that things are starting to tighten up. People are basically starting to prepare themselves for basically less access to available cash. He even goes on to talk about how some of the most dovish members of the Federal Reserve are starting to get more aggressive. Dovish basically are people who are really more focused on unemployment, and hawkish are basically people who are focused a little more on inflation. So the dovish people are basically going to be a little more concerned about hurting small businesses and making sure that people have access to cash when they need it. Even these people who typically don't ever want to increase interest rates are saying, yeah, we got to increase interest rates. And then they had the first 50-point basis interest rate hike in more than 20 years, which is a pretty big deal. Financial conditions are tightening in a hurry, and the Fed's anti-inflation campaign should start showing up in official price data soon. So then the next thing he takes a look at is bond prices. And this is basically showing that bond prices are starting to price in a little bit less inflation going forward, or at least a little bit less of an expectation of inflation going forward. So basically he's taking things like the 5-year treasury bond and comparing that with the 5-year inflation protected treasury bond and looking at the difference between these numbers. And what that seems to show is that early in 2022, it seems like that number peaked, that difference, and now that's starting to come down a little bit to a little bit more normal levels. So we can see the 5-year and the 5-year forward inflation break-evens. The 5-year forward is basically the difference between the 10-year treasury bond and the 5-year treasury bond, and it looks like that number has typically been around 2%, which is usually where the Fed tries to keep inflation numbers, and it looks like this is starting to point down a little bit. We'll kind of have to see if this trend continues. He also talks about how these measures are often the most accurate ways towards forecasting inflation, but these are inflation expectations going out to 2027 and 2032. So then this next part is kind of related to what he talked about earlier, where the price increases caused by the pandemic seem like they aren't really having the same impact going forward. So I talked earlier about the CPI increases, and a big chunk of the CPI increases were caused by the increase in car prices and the increase in airline tickets. And what we can see is there was a giant semiconductor shortage where there's no new cars on the market, so people were having to buy used cars. This in turn made used cars a lot harder to find, so car dealerships were willing to pay a lot more to get used cars on the market, knowing that they could sell them for a whole lot more, which caused the price of used vehicles to go up by a whole lot. But it does seem like that has started to relax, and we do see that new vehicle prices have really started to slow in their increase. So with the loss of this driving CPI going forward, it's going to be a lot harder to see these same inflation numbers. I mentioned airline prices were a big cause in the rise of the CPI numbers. This is looking at the CPI for airline fares, and we can see these really launched over 2022 so far. Apparently this has to do with an acute jet fuel shortage mixed with reopening demand. So we've heard about airlines basically just not having enough people. But either way, this seems like a much more short-term microeconomic issue rather than, a big overall trend change in the cost of airline tickets. So I do expect that this is going to resolve going forward. So then this next chart is taking a look at housing price increases, taking specifically a look at rent price increases. But we know that housing prices have basically increased a lot because of the lack of supply on the housing market. And this has caused some pretty serious bidding wars out there where people are basically running over each other trying to get a house, getting rejected on offers time and time again, which just increases to the overall price of housing. And when the price of housing increases, of course, rents are going to increase as well. Now, I do expect that this is obviously going to slow down with the increase in interest rates, but I do think that this is going to take a lot longer for this to kind of subside. Maybe not really until the end of 2022, maybe even into 2023. Do we start to see the housing prices really start to come back down? But either way, this seems like it's probably around the peak for a lot of the housing prices, and I just don't really think that they have a lot more room to run up going forward. So this next chart is taking a look at the producer price index. This is a little different than the consumer price index. This is basically looking at wholesale pricing increases. And we can see that these have been decreasing over the past year, and it's unlikely that this is going to decline for a long time and the CPI is going to stay high because you're just going to have too much competition where these prices are going to start to bid down and people are going to start to undercut each other. So then this last part of the article, he kind of makes a little bit of a counter argument to himself. But I think there's a really important point within this. Specifically, he says that China and Russia are the two big reasons why we might not have hit peak inflation. Specifically, China's COVID lockdowns might cause more supply chain issues going forward, and these might impact global prices. The other big issue is obviously Russia's invasion of Ukraine, which has certainly disturbed the energy markets. He also goes on to talk about how some of the OPEC Plus members have struggled to hit some of their production targets. Now, Russia's not one of the OPEC members, but they are a member of OPEC Plus, which is a bigger organization than just OPEC. And he's basically saying that Russian oil output missed production targets by 1.29 million barrels per day in April. But either way, the current problem isn't really about crude oil, it's about diesel and jet fuel, both of which are currently experiencing extremely acute shortages, and that's likely to feed airfares, transportation costs, and general goods price increases in the near future. But either way, I do think that these are more short-term problems rather than long-term problems. I don't really see any reason why these things wouldn't resolve. So overall, a really interesting article basically taking a look at how COVID caused a lot of prices to increase during 2021, and how for inflation to continue growing at very high rates going forward, those prices are going to have to continue off those already very high numbers to begin with. It does seem like the overall economy is starting to anticipate some of the Fed interest rate increases, and then of course the Fed actually starting to take action by increasing the interest rates, that they're not just going to let things run out of control for the next decade until somebody else steps in and says, okay, we got to really settle this down. So let me know what you guys think in the comments. Have we hit peak inflation? I'd be very interested to hear what you guys have to say about it. I think if we haven't already seen it, we certainly will over the next couple of months as things start to cool down and get a little bit back to normal. But that's the video, and as always, thanks for watching.